What's going on, everyone? Welcome back to the channel. So in today's video, I'm just going to be discussing position sizing for futures. So we have E-mini contracts and we have micro contracts. So the E-mini contracts is basically the highest size futures contract that you can trade. For ES, it is $50 a point. And the micro of that for ES would be $5 per point because a micro is 1/10 of the mini. And then for NQ, it would be $20 a point. And since for the micro it is a tenth, it would be $2 a point. So that is how the point system works in futures trading. Now let's get into, if you have a $10,000, $5,000, $20,000 account, how much would you want to risk and how many contracts would you need to fulfill that risk and not be over leveraged and possibly, blow up your account. So let's get into that. So let's just say you have a $10,000 account. Now, the thing in futures is, again, guys, it is super highly leveraged. You do not need to have, $100,000, $50,000 in your account to just trade one E-mini contract. Let's say you do have $50,000 that you could put in. I would max put in like 10,000. 5,000. I mean, you do not need to put in the full amount. I would never, ever recommend. This is not stock trading, guys. This is not, worst case scenario. You just hold the stock. No, if you hold a futures position, you will blow up your entire account. You will blow up your entire account unless you have hundreds of thousands of dollars per contract to be able to, withstand any of the drawdown. So just remember that. So yeah, let's say you have like 50,000, max put in like 10 grand. With 10 grand on TradeStation, you'd be able to trade probably like 6 to 8 contracts of ES or NQ, which is insane. So again, you do not need anything more than 20% of the amount of money that you would want to put in. Even if you had 10 grand, you'd be able to trade. Or even if you had 2 grand, right, you'd be able to trade an ES contract and an NQ contract. So just a couple $1,000s is way more than enough. Now, if you want to get perfect risk management, especially for a beginner, this is what I would recommend. So you never want to be risking more than 1% of your account size on, any particular trade, right? So what is 1% of 10,000? $100. Now, in trading, you always want to make sure that you're not trading just based on a, fixed point amount, right? This is something that I've had to just refine over time, and you do have to become very, very adaptable, especially in today's market when it's just always shifting around. It's very, very tough to just have a, static 3-point, 5-point, 6-point stop loss. It's just very, very tough to consistently have that because, the market is just always going to be trading in different places, and one day it might be super range bound, more like, let's say, this kind of action, and other days it might be like yesterday, like crazy downside moves where a little 5-point stop loss just gets totally wiped, literally just in, a couple minutes. So what you want to do is when you place a trade, right? Let's say you're shorting this rejection of 4,300, right? So, and then let's say you look at Bookmap and there is a bunch of, sell orders at 4,307 or something. So, okay, I would need to see 4,308 getting bid and, basically broken through to basically put that trade idea invalidated. So $100 of risk, and we need to fit 8 points into here. So what could you do? Well, if ES micros, right, the micro contract is $5 a point, okay, so $5 a point times 8 points. If you're just trading one micro contract, that would be $40 of risk. $40 of risk. Okay, cool. I need to get this to 100. What could I do? Okay, let's just take 2 micro contracts. So now instead of 5, that's 10. And this becomes now $80 of risk. Okay, cool. It's not at 100, it's not perfect, but quite frankly, it doesn't need to be exactly at, the perfect amount of risk, right? If this was just a point lower, then, it would be 5 times 7. So we don't need to fully have, the amount that we're risking. We don't need to be exact on that. Because again, if you took another micro contract, I think you can see the pattern here, it would be more like $120, which would be 20% over the amount that, we would want to risk in that scenario. So yeah, this took a little bit of time to figure out exactly the right combination of contracts that you would need to trade. What you can do is either A, build a spreadsheet, which what you can do is pretty much just, trade. And on ES, I would say the average stop loss range is anywhere from 5 to 8 or 10-ish points. Let's just say 5 to 10 points. Remember, you'd always want to have your risk to reward ratio be at least 2 to 1. So if I'm risking 10 points on this trade, I would want to make 20 points ideally. And if I'm risking 5 points, I would want to make at least 10. And the other thing that is kind of just tough about position sizing is noticing when to keep a tighter stop loss and a wider stop loss. So on a day, where did we kind of range, right? So on a day like today, you would probably be okay with a static, 5-point stop loss. I mean, look at this action, right? There's only 2. I like to think of these as quadrants, right? Where you look at the price levels going across. So to be able to trade this range, you'd have 1, 2, 3 price quadrants that, you'd be able to trade in. So if you bought at 44.05, stop loss at 4,400, or in this, if you just bought below this quadrant, then you probably would have been good, and would have not gotten stopped out on any of these liquidity grabs below 4,400 right here. So I like to think of price and, stop losses, position sizing as these little quadrants here. It just makes it really, really simple to just see where price has been and just what kind of, stop loss, if you need to have it wider or shorter. And if it's trading just more range bound, then you can have a tighter stop loss. And if it's trading more wide, then yeah, you would want to have, a really, really wide stop loss so that you're not just getting chopped and just stopped out every 10 seconds. And again, that will take some time to just gather the market intuition that you need to be able to know that. But trust me, over time, literally just a few months, it'll get way, way easier to find that kind of stuff out. But yeah, that's basically how you do it. Usually, yeah, just take around 1% of your account size and multiply that, do the math with the points and contracts and all of that. I walked you through it right here. It's very, very simple. Just amount of points times whatever the point multiplier is times contracts. Boom, it'll spit it out. You can just easily plug this into a spreadsheet. Super, super easy. Just use, equal sum and plus and minus. It's very, very simple, very, very basic. or you could just do it on, a piece of paper. And yeah, I mean, and the nice thing about this kind of math is that it easily, it's very interchangeable between mini and micro. It's kind of like the whole kilometer meter system. It's very, very easy to just, divide it by 10 or multiply it by 10 and get the answer if this was a $100,000 account. So yeah, guys, that is basically how you find out the position sizing. Again, just do not put your full amount of capital that you would want to trade with in your futures trading account. Futures is not the product for that. If you're trying to do that, I would just look into stock trading. That is what you would want to do if you want to put in a more sizable amount of money. And so I hope you guys enjoyed this video. I hope you guys learned how to size yourself in futures trading. So now you'll know a little bit better how to manage your risk and position your size. And thank you for watching, and see you guys in the next one.